Here's another reason why I love credit spreads. If you don't know what credit spreads are, make sure you check out this video first, linked in the upper right-hand corner, and then come back to this video. First, let's start with the trade that I took in my Roth IRA, a relatively small account, this week. I sold a SPY 435, 433 put credit spread on August 22nd with an expiry of August 23rd, just 1 day later. I collected $21 a spread and I sold 10 of them, which means that I collected a total of $210 for a total invested capital of around $2,000. SPY ended up at $444 1 day later, and so these options expired worthless, and I generated 10.5% ROI, or for a flat amount of $210 in the course of 1 day. And this is the main reason why I love selling options, in this case, credit spreads, right? Selling options is a great way for us to trade and generate profits, even when you have some other commitment like work. Why? Because we don't really have to worry about how far the market moves in one direction or another. We just have to get the general direction. When we sell options out of the money in particular, the option itself has no intrinsic value. If it were to get assigned at that moment, it would be worthless. The only value it has extrinsic, which comes from somebody believing that the market will go in that direction and to that strike price and is willing to pay some credit to us because of their beliefs. And so when we sell options, in particular credit spreads, what we're doing is essentially trying to take advantage of someone's interpretation of the market while trying to use as little capital as possible. This is really why it's great for small accounts. So let me show you how to sell credit spreads and take advantage of market trends and people misinterpreting these trends. First, let's talk about the two-step process to find these good opportunities. Number one, we have to understand the short-term trend. Is the market in an uptrend, downtrend, or is it going flat? We then want to trade the trend because the trend is our friend. Now, number two, is there a large macro event like CPI or Powell's speech that can throw volatility into the market? No? Then that's good because we don't really want something to come in and shake up the trend that we have already analyzed. Remember, the trend is our friend and we want to trade the trend. So let's examine the trade that I took this week to really hone in on how to sell credit spreads, SPY from this week, to take a look at how to figure out number one, which is trend. This is Friday, Thursday, Wednesday, Tuesday, Monday, and then Friday of last week. So we're just going to scroll a little bit to Friday of last week. So if you look at the previous week, the trend is pretty obvious that it's down. And on Friday, it hit a low of 433. And then theoretically, you would think that if the trend were to continue down, it would form another lower high and then bounce back down, kind of like what my cursor is doing here. But what we're looking for here is to see whether or not the trend will continue to go down for us to trade down in the short term, because we're really only trading weeklies here, right, within the week, or is the trend going to reverse? So on Monday, it opened up to a high, but if you can kind of tell, this is still not a higher high. It can still be considered within that downtrend, right? You can go from A to a B to a C and then continue to go down. But one positive note here is that on Monday, it formed a higher low, right? This pattern here seems to indicate that there could be a potential of a reversal pattern, which means that the short-term trend has shifted from downtrend to an uptrend. What I'm doing now is that I am waiting to see whether or not this uptrend is confirmed and we can take this uptrend trade. And so on Monday, I didn't trade. So on Tuesday, what I'm looking for is a higher low. A higher low would indicate that this went from A to a B to a C. It formed a higher high to a D. Now I'm just looking for the E for my entry. And I decided to enter a trade on this day, the 22nd. I sold it at 435, which is slightly below the previous low. And the play here is very simple. I know the trend now is going up. I expect the trend to continue to go up the following day. And I sold it for an expiry of 823. And I'll talk about why. But the principle of 822, this day, and this entry on this day is very simple. You see there's support right here because you see this long wicks, and you know that the trend in the short term seems to be up. So what we're doing is we're going to try and trade the trend. Now, the question is, why did I sell it for 823 and not like 825 on Friday? Because that's normally what I would do. This comes to point number two. Is there a large macro event in the next 2 days or so, or during the week, that can throw a wrench in the overall trend? You don't want increased volatility here. You actually want predictability. On Friday, there was Powell's Jackson Hole speech. So you can see on Thursday, the market went crazy, right? You can see large bodies, larger volumes. That's the reason why I sold it for the day after for 823, because I expect this pattern to hold at least for one more day. When 824 comes and people are starting to get cold feet about what Powell might say on Friday, I don't want to mess with that, right? However, if there was no Powell speech, if there's no CPIs or earnings on a company, you can sell it for Friday end of week, because you kind of understand that the trend is now shifting towards the upside, and you can let that play out. Expired on Wednesday at like 430, 444, right? I made max profit. However, we have to talk about risks. The risk here is, unfortunately, because you're selling it on a shorter time frame, you are taking on a decent amount of risk, because if the market does overreact, there is no time for your spreads to recover. What that means is, let's say that on Wednesday, right, this didn't hold and it gapped down, maybe down to 435. We're using on demand, which is a function that Thinkorswim has to look back at the historical value of a spread. So this is essentially a market open on Wednesday, the 23rd. So you can see that the moment the market opened, I was basically right out of the money. I am at $14 a spread now. I made $7 a spread. We're just going to analyze this trade, right? And we're going to see what happens if the market opened up instead of right at 439, it opened up. What happens if it opened up like 436? And this is what I mean by risk. You're right here. This is the day open at 439. If you're at 437, you would be down $25 a spread. So you would be at like $40 a spread. If you're at 435, you can see it just starts exponentially increasing. You'd be down like $63. So your spread would be worth $77, right? So this is kind of the risk. If it doesn't pan out, you're going to end up losing a lot more money than you would make. So you have to understand your risk here. This is why I tend to not sell weeklies as often, because there's not enough time for you to recuperate if the market overreacts. However, when the setup looks good, like it does this week, then it's a very fruitful endeavor, because you can make a lot of money in a very short amount of time without having to actively manage the trade. So that's about it. Let me know if you guys have any questions down in the comments below. I just want to make a quick video about how else I use credit spreads. If you guys like content like this, make sure you guys like the video and subscribe to the channel. It'll really help the channel out. If you guys have any questions or comments, drop a comment down in the comments section below. If you guys want to learn more about how I day trade credit spreads, make sure you guys check out this video linked in the end screen right here. Until next time, stay safe in the market. Peace.